Again, for example, let's say we're looking at Nvidia, they've just had earnings, massive move to the upside. Let's say we want to play this short bias. How do we do that? We go over to the trade tab, we go over to the option chain, and again, make sure this is linked to your chart. If not, just put the ticker in here, and then go to the expiration you want. For example, we could go 34 days out. And then let's say again we are bearish on this stock. We're currently sitting around $390, so we could buy an at the money call, or an at the money put, sorry. We could buy an out the money put, or we can buy an in the money put. So again, we can pick either one of these three, or again go further out either way. For example, let's say we're expecting a relatively big move. We can make these strikes, make it show more strikes by doing that. But let's say we expect to move to $350. What we can do is go and buy a 350 put. And again, you can see that's all you would really have to do. It would cost you $675 to buy it near enough at the market. And then you just click confirm and send. One other thing you can do though is if you do want to analyze the trade, you can go into the, you can right click, go to the analyze tab, and now you can see it shows you your defined risk, which in this case is $675. Again, if you are buying an option, whether that is a call or a put, your risk is always what you pay for it, so you can't lose more than that. But again, it can also show you your upside potential if it starts to go your way. For example, if it did push all the way down to $300 at or before expiration, you would be up 4,300. So that's how you do the puts. Now what we could do, and again, for example, we'll just look at a different company, let's say PayPal, and again, let's say now we want to look at the calls. What we could do is again go out the same. Again, maybe we think there's going to be a bounce sooner in PayPal. We could go maybe 6 days out. The options are going to be cheaper. We can go now onto the left side because this is the calls, and then we can say we want to buy an at the money $60 call. And where you can always find at the money, in the money, and out the money, we'll go into a full video on that soon. But what you can basically see is the difference between the blues, that is considered at the money because it's the closest strike to the current value. Now if you go out the money, that's going to be the black ones, and then in the monies are going to be the blues, just so you know. But let's say we're buying it at the money, so a $60 call on PayPal. All you would do is again left click on that, and then again confirm and send if you want to buy that right away. Or again, you can always affect how much you pay for it. Let's say you want to pay no more than $110. You put that limit there, confirm and send. And again, like we said, if you want to analyze the trade to see your max risk and reward, you can see obviously if you're only paying $110 for it, that's your limit order. Your max risk is always going to be $110. And if it goes to the upside, again, if it pushed up to $70, let's say, your call would be up $890. And then what you're going to want to do is you put this where it says spread, it will most likely be on single. And again, you can just come down here and change this to covered stock. Now, what this will do is if we go down to here, and again, firstly, you need to obviously know, do you want to be shorting it or do you want to be buying the shares? For this example, we'll use Palantir. So this is a stock I would consider very overbought. You can see from how I do technical analysis, it is overbought. So to me, I'm looking at a 1 to 2 point pullback to be able to trade on Palantir. So what I'm going to look is obviously trade spread covered. Look out for about a 20 to 30 day expiration. So we'll go out 20 days, or actually we'll go out 27. And then again, what we would look for is where do we think it's going to be below. So again, right now it was trading at about $13.85 in the after hours. So what we'd be looking at is probably having a defined risk above $14. So then what we do is we come over to here. And again, if I'm looking to short the shares, I'm looking to hit the bid. So what this will do, and again, just delete that and show you again. If we click there, what this will do is short 100 shares and buy a call. So again, if we go over then to the Analyze tab, again, you can see exactly what this means. It means your defined risk on this trade is going to be $111. And then again, the further it goes down, the more upside you have. Now, again, this is going to be down to the credit. And this is why you may want to get into the trade this way. Because obviously you can short the shares and then just go and buy the call to hedge your risk. But the real benefit of doing it this way is you can kind of get a more ideal entry. So for something like this, let's say I wanted to get in and only have $100 max risk. What I can do is again put that to a $13 credit, and again you just got to go to the strike and then change your price in comparison. Obviously now there's only a $1 difference. That means we have a $100 max risk, and again just put that lock on so it doesn't change, and then you can see we have $100 max risk, and then if it goes in our direction we can make the money. And then again all you would do is basically just do confirm and send, and then you can send the trade out like that. But this is one really good way to do it, again just for that main being that you can kind of control your overall entry. Sometimes you got to short the shares. Again, you might short them at say $13.50, and then you have to go and buy the call, which again sometimes you don't know how big the spread is going to be, especially if you're not trading super liquid options. So in this case you can kind of get your exact defined risk going into the trade, and then obviously your risk is defined until June 23rd in this case. But again, if the call closes in the money, then obviously your shares will be covered, you won't have to do anything. And then if it closes out of the money, then you can just buy your shares back naturally to again then get out of that, because you no longer have a defined risk. So that's how you can do it if you're trying to short the shares, buy the calls. And again, the exact same thing you can do on the puts. For example, let's say PayPal, for example, I want to be more long biased. The only reason I say that is because it has recently sold off. Probably not something I'm actually long biased on, but just for the example. So we can say it's at around $60. We can say if it's below $60, we want to have our risk defined. So again, then what we can do is go over to the puts. We can look to buy the puts. And again, what you can see here is it will buy one put, and it will also buy 100 shares. And again, then if we go over to the analyze trade, we can see what is your defined risk. Your defined risk in this case is $236. And then again, if it goes to the upside, you've basically got the unlimited upside. Now, again, you can kind of pick your precise entry. So let's say you only want to risk $200 on here. What you can do is change this to $62. Again, the difference between the strike and the price. So that's a $2 difference now, $200 defined risk. And again, this can be good, especially if potentially the options are quite volatile or the spreads are quite wide. Putting the orders out like this, you can kind of get those good fills when it goes in your direction. And then again, the main reason I like it is you know exactly how much you're going to lose before you even enter the trade, or can lose before going into the trade. What you're going to want to do is come over to the trade tab, put in the ticker you want to trade. For this example, we will be using SPY, the S&P 500 ETF. Come down to option chain. You will see spread will be on single. We'll cover that in a second, but you want to pick your expiration date. So for example, you want to go out 6 days, open that chain, and then what you want to do is go over to spread, change this to vertical. Now what you can see is again this has changed all the bids and the ask on both the call and put side. Now what you want to do is, again, this is now going to depend on what you're trying to do. So if you're looking on the call side, if you click on the bid, that's going to be a bearish play, because it's going to be a credit. Now if you go to the ask and you click that will be a bullish vertical spread, and again you're expecting the stock to go up, and again that will be a debit spread. On the left of that will be a credit spread. Now if you go onto the put side, again what you can do is you can click the left. This will be a credit put, so this is basically a bullish move. And if you click the ask on the put side, this will be a downside move. You're basically doing it bearish. So what you can do is pick what one you basically want to trade again, but we can adjust these in a clearer view. But let's say we're going to be bearish on the SPY. What we can do is again look at the puts. We'll look at this one, and again what we can do is then right click on it and click analyze trade. This is really going to be the easier place to kind of see how these will play out, because now what we can see is, again, this is a bearish move because we're doing a debit spread put. Now what we can see is if it goes above $422 or $421.25, that's going to be our max loss of 35 cents. And if it goes below $418.75, that's going to be our max win of $65. So that's firstly, we can see what is our risk to reward. Then what we can also do is change these. So maybe we want to make the strikes a bit wider. For example, we might do say a 422 to a 418. That gives us a $4 difference in strike. So what this now means is, again, you can see now our max risk has gone to $152 and our max reward has gone to $248. So again, firstly, you can play around with the strikes in here to find a more ideal way to play this. And another thing you may want to do is, let's say if you're debating doing, for example, if we want to be bearish, whether we want to do a debit put spread or if we want to do a credit call spread. And again, how can we then see that? So what we do is we change that to calls, and again, then we change that to a do that. And then again, you can always just play around to find exactly what you want, but you can see in this case, we would get paid $250, or 200, well, we can change that to 250 to make the numbers clearer. Then if it stays below $420, we keep our max win, our credit of $250. If it goes against us, so if it goes higher, then again, we have our max loss of $150. So again, you may want to just be adjusting between these. In some environments, the credit spreads can work better. Some environments, the debit spread can work better. So again, it's just filtering through. Using this Analyze tab can really help with that. But overall, again, go to the trade column, put your ticker in, change the spread to vertical, and that will basically give you the outline of the vertical spread. And then again, you can just manually adjust the things you want to adjust to find your ideal outcome. To get straight into it, what you can see is, for this example, we're going to be looking at the SPY, so the S&P 500 ETF. And all you would want to do is come down to the option chain again, pick your expiration. So let's say you want to go out, say 20 days or 27 days. What you would do is you open that expiration. And now there's two ways you can do it. Firstly, what you can do is you can press Control if you're on Windows. And what you can do is basically click on the buy the put at the 420, and then you also buy the call at 420. So you can see that would create for you your straddle. And that's how you could do it one way. But another way you can do it, and especially if you're looking at probably what's the best for your money straddle, the easier way to do it is you can come up to here, click spread, and then again you can change this to straddle, and then this will show you how much it costs to get a straddle. And again, now you can click on basically either side. It's the same thing because it's buying both the call and the put. So if we're looking at, say, the 420 straddle, what we do is left click. Again, if you left click on the ask, that will buy the straddle. If you left click on the bid, that will sell the straddle. But again, you can always adjust it manually on this side. That would be to sell the straddle. That would be to buy the straddle. And again, we can do that same thing, analyze trade. If you wanted to see what your risk to reward is on this straddle. So again, you're risking, it's what going to be whatever your debit is. So let's say it's $1350. Your max risk is $1,350. And then again, if it does a big move either way, you could be up, if it goes to 460, you'll be up 2,600. If it goes down to 380, you'll also be up 2,600. That's how the straddle works. That's how you can set it up on Thinkorswim. So to get straight into it, we're going to be using the S&P 500 ETF SPY as an example. Now there's two ways you can do this, and again we'll go through both of the ways that you can do this. So let's say we wanted to go 10 days out expiration. What we do is obviously open that part of the option chain up, and then again what we can do is manually do it. So if you're on Windows, you press Control and you basically click the put and the call. So let's say we want to do a 420 put and a 422 call. So again, we left click both of those, it will buy the call and a put as a strangle. So what we can do is analyze trade. We can see how this would perform. So you can see your max risk, and you can also see what is your max reward. And again, also in here, you can kind of find your sweet spot. You can adjust it. So let's say you want to actually do a 425 call, a 420 put. You can see that would have reduced the cost by about $100. But obviously that means it will affect your upside or downside potential. So that's firstly how you can do it manually. Another way you can do this is by going into the spread option, and then again just click strangle. Now this will do it all automatically for you, but you don't get as much freedom on the calls to the puts. So in this case, it's doing a 421 call to a 420 put. So again, what we could do is we can actually click that, or let's say we want to do a 413 to a 412 just to make it a bit different. let's say we want to buy that. Again, we can analyze trade. And again, that will show you your upside, downside. Again, you can change it here if you want to actually change that to say a 415 to a 408 or something. And again, you can do all of that, and you can either send it off by doing confirm and send. Again, all you have to do is right click, confirm and send. That will send off your trade for the debit of $11.20. Or you can go down to trade, and again, you can adjust it in here. So again, let's say you want to do 415 and say a 410. It will cost you $932. And then again, you can right click, confirm and send, or you can go to the bottom right, confirm and send. I hope you guys enjoyed the video. If you did, why don't you check out this video, because you'll probably enjoy that one too.